Okay, in chapter 24, we are interested in measuring the performance of the company, segments, branch offices, individuals of each company. So, in the end of the day, the goal of managerial accounting is to not only plan and control, we need to post-evaluate the managers, individuals, employees, divisions' performances. And in order to do that, we need correct relevant measures to evaluate those people, right? So that's why we need to learn about what kind of performances are we talking about, how can we measure them, right? And what are some drawbacks of each measures. So we're going to begin with looking at different types of performance measures. The first is the financial measure. The second is the non-financial measure. So financial measures are everything related to monetary terms. So these monetary terms can come from the financial statements. Especially, these financial statements would include items like the income statement, IS, or the balance sheets, right? So using the numbers from the income statements or balance sheets, or even the market returns that are not necessarily from financial statements, but are still in terms of monetary term, they are called financial measures. Okay, so the stock returns. Stock returns can be a good financial measure to evaluate the company's performance as long as we assume market is efficient. Easily speaking, market efficiency means that the market knows very quickly. They can absorb a certain information, evaluate it very efficiently, and evaluate the company based on those information. In other words, we assume the market is smart. Okay? If the market is smart, then the company can be evaluated based on stock returns. Many big tech companies like Google or Apple, their executives are paid on stock-based compensation. So if they're good in terms of stock return, then executives gets a lot of bonuses. Okay, and the stock-based compensation is unfortunately more widely spread in US, but not so in Korea. And the reason is because many people think, including companies, think the market is not as efficient as in the US. So the stock prices can be not fully representing the company's performance. Another financial measure can be accounting numbers, like the ROA. So ROA, we will learn today, is income over assets. Okay, so income comes from the IS, income statement. Assets come from the balance sheet, right? EPS is the earnings per share. So how much income, earnings, out of the total shares outstanding? Okay, so this is a key metric for financial analysts especially. Financial analysts, all they do is they track several companies like A, B, C, and what they do is they try to estimate the EPS of a quarter 2025 or year 2025. And they are actually compensated, rewarded based on how accurate these EPS forecasts are compared to the actual EPS of a company. This is a key metric for financial analysts. And this is a key metric that people see, especially the institutions like the mutual funds, hedge funds. When they evaluate companies, they focus on how much earnings they're going to be get distributed for each shares. Sales. Well, although I have written as sales, it's not necessarily in dollar amount, but many times it's going to be based on a ratio of sales over assets. Okay. Again, sales is from the income statement. Assets are from balance sheets, right? And sales over assets is called the asset turnover. It's one of the key efficiency measure in a company. So how efficiently can you turn the assets into sales is a key consideration for a company and when investors evaluate a company. Okay, so all these numbers, whether it's from the market or whether it's from the balance sheet or income statements, as long as it's in terms of monetary, it's related to financial measures, most commonly used to evaluate a company and individuals in a company. Non-financial measure is not necessarily monetary, but it can be anything other than monetary. So it's a more broad measure. And non-financial does not mean that it shouldn't be based on numbers, right? It still can be based on numbers, like the customer satisfaction. Customer satisfaction is something that we can't count in numbers, in dollars necessarily, but we may know the number, numeric ratings, like 6 out of 10, 7 out of 10, right? Service delivery speed, right? Let's say for the delivery, it takes 1 day or 2 days. You can compare that with the same peer in your industry to see how speedy this delivery is. Employee turnover rates. So turnover, how many employees are gone within a year? Is it 30%, 50%? Right? This is a key metric for employees, potential employees when they are applying for a job. Product defect rate. This is important for the customers, right? Out of 100 products, how many out of them are likely to be defect? Is it 10? Is it 5? Is it 1? The lower the better, right? So all these metrics, although it's not in terms of monetary, it's still related to numbers. Of course, there may be even non-financial, non-numeric metric, which, like let's say, employees can rate the company, but they can also talk about the company in a sentence, right? And we can kind of measure the tone, right? These tones, not necessarily a number, but it's also something we need to consider when evaluating a company. As you see, non-financial measures are less rigid and less legit in terms of evaluating the company. There can be some subjectivity involved, right? And that subjectivity can arise, these subjectivity can lead to conflicts among employees. Let's say, if we are rated upon the customer satisfaction and some employees say, hey, the customer satisfaction score is not very accurate, so why should we be evaluated based on the inaccurate measure, right? So in order to use the non-financial metrics in performance evaluation, there should be a sympathy among the interested parties, like the employees within a company. They should be in a good terms in terms of whether or not to use that non-financial measures. Okay, so broadly speaking, financial versus non-financial, we've talked about it. And now we're going to talk a bit about what types of evaluation method there are. Okay, and one of them is called the relative performance evaluation, or the RPE. RPE is when you evaluate let's say a company's performance with a peer company's performance. Okay? I mean, it can be within the company, it can be one segment A versus segment B, but let's just say it's a company performance versus the peer company performance. Okay. Okay, so that is evaluating the performance to relative peers. Why do people use that? Well, there are clearly some advantage of using it. One of that is that you can filter out the common risks. So common risk that would come out purely out of luck. Luck is something that you can't control, right? Let's say you're trying to take an exam tomorrow, but you became sick. And sickness is something that you can't control, right? Disease is something that you can't control, like COVID period, where every company was going through a downturn. That was unavoidable, right? That is the common risk. You don't want to be evaluated based on a risk that you can't control, right? So again, financial crisis, everybody did really bad. Not because you did bad, but it's because the market situation it turned out that way. And another flip side, let's say economic boom, everybody do great. It's not because you are great, it's because the economy is great, right? So you shouldn't be evaluated favorably based on those pure luck out of a good economy. So either bad or either good, you want to filter out those common risks, right? Another good thing is that it can bring benefits of competition, right? Let's say if the executive is paid based on the RPE, and meaning that your performance will be evaluated against your peers, then the natural incentive for your executive is that you want to do really good compared to your peers, right? So there is clearly a benefit of putting peer benchmark together side by side. That allows you to compete against your peers and do better, right? So of course, excessive competition may bring emotional distress for these executives, but a bit of competition can actually bring a favorable performance to your company and also to motivate you better. So in fact, about 25.44% of these S&P 1500 firms in the US. So by the way, in the US, these 1,500 firms are with the largest market cap, and they account for 90% of the market share. So this is almost all the company in the US in terms of market size. So it's a very significant group, okay? And what they say is that they use the relative performance evaluation in executive compensation contracts. So 25.44 is quite a significant amount. But there is some caution for the RPE. When you use RPE, I said that we need to screen out the luck that we can't control, like the market boom or market crisis. But what if there are luck that you can control beforehand, which we call as controllable luck? And the suggestion is that you shouldn't be filtering out all the controllable luck. What does it mean? Let's say, for example, you are a company where you do a blind screen, right? So you don't know the applicant's, how applicant looks like, or what is their, gender, and what is their, let's say what is their qualification. But what does this mean is that you shouldn't be filtering out everything, but something like applicant's university name can still be shown to the interviewer. Why? Because university itself is not just purely based on applicant's luck, right? You just don't apply to university purely out of luck. I would say 80% or even 90% are based on the effort, right? So you shouldn't be ignoring this effort side when you're screening, right? So essentially, the university is a controllable luck that we shouldn't be screening out when doing the blind interview. And also, let's say you're a multinational company, right? And you have offices in Switzerland, you have office in Japan or Singapore, whatsoever, right? And each country has their own risk, country level risk, right? So according to filtering out the common risk, you may think, okay, so when evaluating this multinational company, we should be filtering out all the country level market risk. Well, that's not exactly so. The reason is because you are the one that have entered into this country, right? So there was a selection process of each country, which is not purely out of luck, right? It's somehow responsible. There's some responsibility and accountability toward the manager that picked these regions, right? So it was a controllable luck itself, choosing the right region and timing. So you shouldn't be filtering out every side of the country market level risk when evaluating this company. Okay. Oh, and by the way, for the chapter 24, even if you have read the textbook, you may still see a lot of deviation with what I have prepared. And I admit that, but so try to focus on the contents on the slide rather than on the textbook. Of course, textbook is a good leading source, but I have more sources on the slides, which I would suggest you to more focus on. Okay, and yeah, this is one example from Pfizer. So every U.S. companies have to report the peers against which they are compensating executives. So they report on what's called Schedule 14A each year. This is a Pfizer's disclosed peers. So on the left-hand side, you see a pharmaceutical peers. And on the right-hand side, you see a general industry comparators. Okay, so pharmaceutical peers, as it said, is a broad mix of large companies from pharmaceutical industries. Okay, so there is AstraZeneca, Gilead Sciences, Johnson & Johnson, Novartis, very large companies from pharmaceutical industry. On the right-hand side, there are industry peers, general industry peers. They are not necessarily pharmaceutical, but they have chosen companies of similar size and complexity in terms of, I would imagine complexity based on how many number of segments, geographic segments or operating segments you have, or how many number of employees you have. So there is 3M, Boeing, Chevron, Coca-Cola, ExxonMobil. All these companies are not necessarily pharmaceutical, but they are of a similar size. So Pfizer compares not only to their industry peers, right? They also compare themselves with the general industry peers, as you see in terms of revenue, income, and market cap. Okay. So the way you select peers is quite subjective, right? It is based on their aggregate opinions in the board members, right? So it's quite a subjective matter. Okay, so that was it. Another thing is what's called a subjective evaluation. Okay, so subjective evaluation is based on determining based on subjective opinions, subjective measures. So what is different? Well, you give a different weighting of objective measures ex post. Meaning, let's say before applying the subjective evaluation, let's say a certain CEO is compensated based on 30% based on how well they have generated revenue, and 70% was based on, let's say, cost. But some odd reason, let's say in that year, revenue, there was something that was big where they weren't able to control costs. So there were many portions where they weren't able to control from the cost side. If that's the case, the board of directors may come up with the decision, say, okay, instead of having the weighting of 30 to 70%, how about we do as 40% to 60? The reason being, there are many portion of cost side that is not controllable. Therefore, let's put a less weight on cost and put more weight on revenue. Right? Or another thing is you can just be more subjective and, let's say, ex post, based on all these weightings, you provide 1 million to CEO, but let's say, no, holistically speaking, generally, broadly speaking, CEO has done better than what he has done for $1 million. So board of directors come up with a decision, say, instead of giving him 1 million, let's just give him 1.2, considering that he has done quite large portion. He has contributed more than $1 million. So this is the ex post discretionary adjustments. So why do we use subjective evaluation? Because it can capture truer effort of employees. Okay? As long as you can monitor these CEOs better, if you're closely watching how the CEO is doing, you can capture the true effort of that CEO, and you can it reflects his or her true efforts more by applying the subjective evaluation. And it is also one way to reduce risk, because objective performance measures can still be noisy, as you can see from revenue versus cost. It can introduce uncertainty, right? So like the board of directors, they can come up with better subjective evaluation to compensate the agent, the CEO, for bearing the risk. Okay. Another reason is the board of directors, they don't want to make the CEOs too short-term focused, right? Let's say if the CEO is purely evaluated based on revenue and cost, then he or she may have some incentive to, boost up revenue intentionally and reduce cost whatever the way, like firing an employee, which is an excessive way of reducing risk, right? So it can make the CEOs too short-term focused, whereas the board of directors want a long-term success of a company. Like in 5 years, 6 years, how would the CEO would lead? So in order to compensate and in order to motivate the CEO long term, not only are they evaluating based on revenue and cost, but they can see a vision, how visionary the CEO is, right? How passionate those CEO is, right? And that can be a good measure for the long-term focus of a CEO. So another reason why subjective evaluation is used is in a similar line as this example. If you are too focused on revenue and cost, then the CEO may manipulate those performance measures in any way, right? So they want to actually provide this alternative evaluation method to limit the manipulation of CEOs. Okay, so this is one dialogue that you can take a look. This is an example for the subjective evaluation. I want to have you to read. Now, I want to also provide some, I would say, downside of subjective evaluation. So there can be some biases applied when applying the subjective evaluation. The first is what's called the halo effect. This, by the way, is, if you click this, it's going to be linked to a YouTube video, okay? That will pretty much clearly describe what the halo effect is. So what the halo effect means is you may have a general assessment of a certain person. Let's say you just see employee A as a good person in terms of personality, okay? While employee B, let's say he's quite an introvert in terms of personality, so you don't see him quite great. But let's say, objectively speaking, employee B does a better job than employee A. But just because you see employee better, you may give a higher rating to employee A versus employee B. Okay, so it is a tendency to use your global evaluation when making a dimension-specific ratings. Okay, so it's one bias that you may have. So in order to mitigate the halo effect, what the evaluators can do is you can ask other people for assessments, right? So, for example, again, employee A versus employee B, although you may see employee better, other people may find B a better worker in terms of sales generation, okay? So if you ask 3-4 people and there are common reviews saying B is a better sales generator, then you should apply that in your subjective evaluation. There's another thing called the leniency effect. Many people tend to give better ratings than the average, than the midpoint. Okay, so let's say if there is a scale of 1, 2, 3, 4 to 5, 5 being a better, 1 being poor, you have a better tendency to give 4 or 5 than 3 or below 3. Okay, so this is a bias to be lenient against the person you are evaluating. So in order to mitigate the leniency effect, in terms of rating, instead of providing a numerical rating only, you can tie these numerical rating with a detailed description on what each numerical rating would be about, right? So descriptions would be about facts. like 5 being always meeting the deadline, 3 being sometimes you have to give a reminder to that person, 1 being often misses the deadline, even if you provide frequent reminder, right? So this factual-based description can allow evaluator to be less lenient and to be more objective. And then there is the centrality effect. Centrality effect is because sometimes evaluators, they don't know the person really well. They want to be quite conservative. Or it may be simply because the evaluator is lazy. He may have some time constraints. So you may just frequently and conveniently use midpoint to rate that person. That's called the centrality effect, to be centered around the midpoint. So then what would be one mitigating factor? Instead of giving a scale of 1 to 5, let's say, so that there is a center 3, how about giving 1, 2, 3, 4? So essentially, in 1, 2, 3, 4, there is no midpoint. So you have to either pick 2 or 3, even if you are centered around this mid range, right? So in this case, then the leniency effect can arise and you may give 3 instead of 2. So it's better off to provide the detailed description of each numerical rating. Okay, so that was some points about biases in the subjective evaluation. So RPE and the subjective evaluation is quite commonly used. And now we want to focus on some financial measures. So we are back to financial measures. And out of the financial measures, we want to focus on 3 things, which is ROI, RI, residual income, and the EVA. Okay, so economic value added. So these 3 are the bottom line. And you should be able to calculate each metrics. Okay, so ROI is a widely used performance measure when you are measuring divisional managers' performance. Why? Because divisional managers are usually managers of investment centers. Remember, the investment centers are responsible for not only the revenue and cost, they are also responsible for investments, right? So in order to evaluate how profitable the investment is, you can do the ROI test. ROI there are many ways to evaluate ROI, but let's just have a fixation. Let's just fix that our ROI is going to be based on net operating income over the average operating assets. So the net operating income is the income that you generate before subtracting the interest expenses or tax expenses. So this is an income that, broadly speaking, is provided to 3 types of stakeholders, which is the equity holder, debt holder, because you're not netting out the interest, right? It's also providing to the government because you pay taxes to the government, right? So net operating income is essentially focusing on these 3 types of stakeholders: equity holder, debt holder, and government. In order to evaluate the operating income, the best way is to have a one-on-one match in the asset side. Meaning, instead of using total assets, it's better off to use average operating assets. Why? Well, it's because if you include total assets or non-operating, Non-operating assets includes some assets that you are not operating yourself. And these do not generate any sales. No sales, right? So why would you want to include those assets that are not operating and not including sales? Whereas we are interested in how much sales can we gain, how much income can we gain on the assets that we are able to operate, right? So in order to have one-on-one, we want to have net operating income over average operating assets. Okay. So net operating assets are including cash, accounts receivable, or inventories, PP&E, plant, properties, and equipment, and productive assets, meaning assets that can generate sales. Okay, so what I mean by average is, let's say the operating assets can have beginning balance and the ending balance of 2025, right? So in order to get the average, you have to take the average between the beginning balance and the ending balance of the operating assets, okay? That's what I mean by average. Sometimes, some companies may use the net book value of depreciable assets, meaning you may only be calculating these inventory, PP&E, and productive assets. So not even including this cash and accounts receivable. Because you can think that cash and accounts receivable, this itself does not generate any sales, right? Whereas we're interested in out of the operating assets that are able to generate sales, how much income can we generate? So more strictly speaking, some companies may even delete these cash and accounts receivable. But in our case, let's assume that cash and accounts receivable are also included. Okay. Other real non-operating assets like land for use or investments in another company, building rented to someone else, these will be excluded from the denominator. Okay. Of course, when you make an investment in another company, let's say, you can get financial gains, financial income. But financial gains or losses is slightly different from operational side, which we want to not consider when we are calculating the ROI. Okay, so in many cases, ROI are decomposed into two parts, which is the net operating income over sales times the sales over average operating assets. Well, ROI decomposition into these two is actually introduced by the company called DuPont. The executives in the DuPont in 1919 has decomposed the ROI into these two parts. So basically speaking, the net operating income over sales is the profitability measure, meaning how much income can you make out of the sales. Okay, and the another part is called the efficiency measure or the activity measure, which is sales over assets. This part is called the asset turnover. The former part is called the profit margin. Okay, so profit margin over asset turnover, profit margin times asset turnover is the ROI. Why do we decompose it? Because just like in the variance analysis, where remember we decompose into very different types, we want to see where the high or low ROI is coming from. Is it because we are making higher or lower profitability? Is it because we are efficient enough or less efficient? Okay, so in order to improve ROI, we can either increase sales, but if you increase sales, another downside is that will lead to lower profitability, right? So in order to maintain high profitability, you have to reduce expense or even more expenses than how much you increase to maintain or have higher profitability. Another way is you can reduce assets. Reducing assets or reducing expenses means you make company leaner, make it leaner. You make it an efficient company. Okay, so let's look at a hypothetical company called Regal. This is a company with a net operating income of $30,000, average operating assets of $200,000, sales of $500,000, and operating expenses of $470,000. Okay. So in this case, the ROI of a Regal company is the net operating income of $30,000 divided by the average operating asset of $200,000, which is going to be 15%. We can turn this into the DuPont analysis, right? So the first part is net operating income over sales. And the second part is going to be sales, 500,000 over assets, 200,000. So we can see the profit margin of 6%, asset turnover of 2.5, and multiplying that, we can yield 15%. Now let's say the Regal manager invests in a certain piece of equipment, $30,000. And that can increase sales by $35,000, and it will also increase the expense by $15,000. So in terms of the increase in operating income, it will be $20,000. Right? Right? Yeah. So you can now see an adjusted ROI. Let's break it down into the DuPont analysis. So instead of now having 30,000 as income, we now have 30,000 plus 20,000, which is 50,000. And sales also increased by 35,000 from 500,000. So 500,000 plus 35,000, right? So that is the first part. And the asset turnover is going to be 535K divided by assets increased by 30,000, right? So 200,000 plus 30,000 is going to be 230,000. So the ROI increases to 21.8%. If we look at the DuPont analysis, the profit margin increases from 6 to 9.35%, whereas the asset efficiency, the asset turnover actually decreases to 2.33, right? So we can see that by investing in this new equipment, the profit margin increases while the asset turnover decreases to a smaller extent, so that overall the ROI increases. But there are still some downsides of the ROI. Why? Because if the managers are evaluated purely based on ROI, imagine managers can become short-oriented, as said earlier, right? And they may take some intentional, manipulative actions to increase ROI, but it may, in the long run, harm the company performance, which is not going to be consistent with the company strategy, right? So instead of using ROI solely, it can be used as part of some other financial metrics. So we will learn about the balance scorecard in a later part. The balance scorecard approach takes financial metrics as well as non-financial metrics. Okay, so that the company manager is not too short-term focused. And this part is also related to the common risk side. Remember that there can be some uncontrollable luck, like the market downturn, right? ROI can be affected by these common risk, right? So managers should not be evaluated based on something they do not have control over. So solely relying on the ROI measure can be risky. Last one can be something that you may not be able to understand now, but we will see an example from RI. So sometimes there can be a investment opportunity. Okay, investment opportunity. So when you invest, you also have to think about what is the ROI of taking up the investments. But sometimes when you take up the investment, your before taking up the investment, let's say the ROI is 15% in your company, but after taking up certain investment, it can become 12%. So you can falsely reject the investment opportunity by saying, oh, the ROI is now gone down to 12%. So I'm not gonna take up the investment opportunity. But we will also talk about RI. So RI focuses on the dollar amount. But let's say pre-investment opportunity case, you see a incremental operating income of 10,000. But after taking up the investment, let's say the income becomes 12,000, right? So actually, in terms of dollar amount, you're doing better, so that it is better off for you to take up the investment, right? So simply looking at the ratio, meaning the ROI, may not give you the right answer. So you have to see both the ratio and the dollar amount. Okay, so that's why we are now going to look at residual income, RI. This is another measure of performance. Okay. In other words, it's the net operating income above the minimum required return on the operating assets. One thing to note is that this one, OI is the EBIT. This is the same number from the ROI numerator. Okay? This is the average operating assets. This is also the ROI's denominator. So the numbers we use is the same. The only difference is now ROI is focusing on the dollar amount instead of the ratio. The only difference is now we're going to multiply the average operating asset by the minimum required rate of return. Okay. Minimum required rate of return is actually based on a equity holders rate of return. So there is some slight mismatch here, because I said that operating income is an income for the equity debt holders and the government, right? So in order to look at pure income for these three stakeholders, actually minimum required rate of return should consider not only the equity holder but also debt and tax receivers like the government, right? But debt holder can make sense, but tax governments, there's no minimum required rate of return for the government. It's a bit too challenging to consider both the debt holder and tax government. That's why we conveniently use the equity holder's rate of return as a minimum required rate of return. Okay. We're going to talk about how we get the minimum, equity holder rate of return, but it is basically based on what's called the CAPM, the capital asset pricing model, which you will learn from finance class. I'm going to talk about it a bit more roughly here. Okay, so let's look at one by one. ROI is in terms of percentage. ROI is in terms of dollar amount. Residual income measures, right? The OI earned less the minimum required rate of return on the average operating assets. Residual income focuses on the profit size, meaning the dollar amount, right? So sometimes it can encourage managers to take up the investments that would have been rejected when you only rely on the ROI. This has been briefed here. But one downside is that it cannot be used to compare the performance of divisions of different sizes, right? Because different sizes have different assets, and therefore the residual income would definitely be different, right? Higher asset-sized division is likely to have a higher residual income automatically. So you can't compare apple to apple based on RI. But residual income is likely to be used for this purpose, right? Whether or not to take up or reject the investment opportunities. Okay, so then let us focus on how we can get the minimum required rate of return. So as said, the minimum required rate of return is based on a CAPM, which is the following. So this is the expected portfolio return. Expected return on a portfolio. Let's say this is just a company's expected return. And this is exactly what we are pursuing here, minimum required rate of return. And this is the unknown part. And here, RM is the expected market return. Let's say the market is the S&P 1500 index. Okay, and the RF is the risk-free rate, meaning how much yield can we get, how much return can we get on a risk-free investment like a treasury bond. Why is the US Treasury bond a risk-free investment? Because, it is really highly unlikely that US will default, right? So if you own this bond, you will get the interest and principal on those bonds from the US government no matter what. It is really less likely that US will default, right? Because US is the biggest most wealthy country in the world, right? So usually when we calculate the risk-free rate, we use the yield on the US Treasury bond. So basically the RM minus the RF is called the market risk premium. Market risk premium, in a easily speaking word, is what the market requires for, let's say, the S&P index. How much the market requires for the general S&P index companies to earn above and beyond the treasury bond. Right? So when you see a premium, it is about how much the market is requiring. Why are market requiring higher return than the treasury bond? Because it's all about risk. Treasury bond is almost risk free. There's no risk. But even for big companies, they can still have risk, right? They can still be going on a default. They can, go downturn really quickly if they are facing financial crisis, right? Like think about Bear Stearns. It was a big financial companies, but they went to the bankruptcy in the financial crisis. Just like that. Into trash, right? So even for like S&P index companies, they can still have risk. So for higher risk, you want a higher return. So that is this market risk premium. And just like that, this part right here is the how much the investors want above and beyond the risk-free rate, right? So this is also the risk premium on a company. And beta is something that you will always see. It's called the stock beta, meaning how much the company's return is affected by the market risk premium. This is just like a operating leverage example, right? Like, let's say the market risk premium is, if the market return goes by 1% and your beta is like 7%, then that means that your portfolio return, your company return will also be expected to increase by 7%. And otherwise, let's say if the market goes down by 1% with the stock beta of 7%, the company return will also go down by 7%. So it's like a sensitivity of the firm return on the market premium. Okay, so then how do we go about this? So let's say usually you can you can estimate the portfolio return based on the time series. Okay. So you would need the time series for the company return, let's say RP, and then the RF, the risk-free rate, and the market return, right? So let's say you start from like 2000 to 2025, and you already have all these numbers because it's a past number, right? So after gathering up this number, what do? You can do an estimation. You can estimate, say, using a regression model. Regression model will give you the beta estimate. Okay? So beta estimate is what you want. After getting the beta estimate, what you do? You want to know, what is going to be 2026 company return. So we are interested in this number right here. And we can calculate this by beta hat RM minus RF plus RF. So these numbers will be known to you. Like RF is the risk-free rate. that you can also use from like the government website. They have the projected yield on treasury bonds. And for the market return, expected market return can be used based on, let's say the last 5-year or 10-year S&P return, or you can use the projected estimate by the analysts, because sometimes the analysts can give the expected market return. Okay, so suppose that you know these numbers, then you can calculate the company return, and that will be used here in the minimum required rate of return. Of course, it's not a finance class, and I'm not gonna, require you to calculate these. You don't even have to know it's through CAPM, but I just wanted to show you, practically speaking, how you can get this required rate of return. Okay, now back to the residual income case. But before that, I will end the video here, and I will make another new clip